I'm Jamaica Zarchkoff, the Regional Vice President of Sales for Western Canada at Invico Capital Corporation. And today I'm going to talk to you about our signature fund, the Invico Diversified Income Fund. And this fund has over 11 years of positive performance. As with all exempt market products, please make sure that you review the offering memorandum in its entirety before making a purchase and sit down with your dealing representative to make sure that this investment is suitable for you. As well, throughout the presentation, there will be some forward-looking statements. And before making any purchases, please make sure that you know your investor rights. As well as with all investments, there are some risks associated with this fund. So let's invest with confidence. Obviously, right now we're in a period of economic uncertainty with a lot of volatility, trade disruptions. Investors are really looking for a reliable, consistent source of income, and that's really what we provide with our Invico Diversified Income Fund. So our Class B unit is targeting a base 8% a year, paid out monthly, with the ability to do additional distributions on a quarterly basis when earned. And why we're able to maintain this track record is we are an award-winning Canadian-based fund manager with cross-border capabilities. So one of the things that makes us unique compared to a lot of our peers as Canadian fund managers is that cross-border capability. So we can transact in both Canada and the US. And the way that we've set up the fund, we are able to deliver a positive yield in volatile markets and offer downside protection. As I mentioned on that first slide, we've never had a negative year in our fund's 11-year history. And part of that is because we really provide resilient credit investments. So when we're underwriting any sort of loans, on our direct lending side or getting into any sort of syndicated credit scenarios, we really focus on a bottom-up approach and make sure that the companies that we're lending money to have free, strong, consistent cash flow because we're making those monthly distributions to investors. As well, on the energy side of the sleeve, we have in-house expertise. We have 4 engineers on staff. So we're really able to transact really well in that space. And again, we have that proven track record. We are going to hit the 12-year anniversary of the fund in September. And as I mentioned, in the past 11 years, we've never had a negative year in our fund's history. So let's do a little bit of an introduction. We're going to start with the company and then break it down through the fund. So Invico Capital Corporation manages $3.6 billion as a firm, all deployed in the private capital markets. We have an over 19-year history with the firm, so we'll actually be having our 20-year anniversary in September. We're very excited about that. We have over 100 years of underwriting experience, and as a firm, we have won 8 industry awards over the last 20 years, including one of the awards that I'm most proud of was in 2023. We were named Canada's leading alternative solution provider by Wealth Professional. So very proud of that and our track record. And on top of our signature fund, the Invico Diversified Income Fund, we are IFM or investment fund manager to 6 funds total. So that's important to note because a lot of fund managers, especially in the exempt market space, are just registered portfolio managers or PMs, but we have that extra designation as IFM or investment fund manager, which means that we're held to a higher set of regulations and standards. Now, our Invico Diversified Income Fund, or IDIF, as we like to call it, has over $500 million in AUM. We have that 11-year track record. Actually, we're going to hit that 12-year anniversary at the end of September. And as I mentioned, we're paying out that base 8% a year, paid out monthly, with that ability to do those additional distributions on a quarterly basis or top-ups. And since Q1 of 2022, we have done 7 of those additional distributions that we pay out on a quarterly basis if earned. As well, we have over 9,000 unique investors within the fund. Another reason why I like to bring that up is it shows you that we don't have any concentration risk, even on the investor side. And this fund has been a 12-time Canadian Hedge Fund Award winner in the private debt fund category. And this is really why we've been able to maintain that track record over the last almost 12 years is our management team. So Allison Taylor and Jason Brooks are the two co-founders of Invico Capital Corporation and the two original portfolio managers on this fund. Allison is our CEO and Jason Brooks is our president. Chris Watsky is the third PM on this fund, and he is also our CIO or Chief Investment Officer. The three of them all bring over 30 years experience within industry. Dave Hawkins is also on the team. He's our Senior VP of Diversified Investments, and he really heads up the equities yield sleeve of the portfolio that we'll talk about a little bit later. And then Tyler Gramatovich is a fourth PM on the fund, and he is Vice President of Investments, and him and his team really run our syndicated credit sleeve of the portfolio that we'll talk about a little bit later as well. And then Sarah Pettigrew is our Vice President of Energy Investments, and she is one of our four in-house engineers, and she really heads up the energy side of the portfolio and manages that team. On top of these 6 individuals running the investment team, there are an additional 8 underwriting professionals on the private debt side and another 10 dedicated energy staff. As well, we have 21 members of our accounting and operations team. So let's talk about the portfolio a little bit more in detail. So we have a very unique fund. We pair private debt with non-operated energy working interests and royalty positions. So a very unique combination of assets. In fact, there's not another fund like us in Canada that pairs those two asset classes. But why we did that is they're both cash flowing assets. And that's what we really are, is we're a cash flowing vehicle. We're paying out that base distribution plus those additional distributions. So we're not really a growth story. You're never going to see a situation where our unit price jumps from, let's say, $10 to $15. When we have that extra money on hand, we're going to pay that out to you guys by way of those additional distributions. So that's really your experience with us when you're investing with Invico, is through our distributions and that consistent cash flow. As I mentioned, we're a private debt fund with what I call an energy kicker. So that's the way I would describe us if I could say it in one sentence, because we are such a unique combination. So when we're looking at the lending side of things, we would do either direct lending or through syndicated credit in the US. And as you can see, it is 39% of the portfolio at the beginning of 2025. So we are slightly underweight on the lending side of things. We typically like to see that anywhere from 50 to 60% of the portfolio. On the energy working interest and royalty positions, we like to see that sleeve anywhere from 30 to 50% of the portfolio, and it is right on track there at 41% at the very beginning of the year. And then our equity yield sleeve can go anywhere from 0 to 25%. It was sitting at 16% at the very beginning of the year. And really, the equity yield sleeve is a byproduct of being in the high yield lending space. So that equity yield sleeve would consist of any sort of additional warrants or royalties or kickers that we negotiate in some of our loan terms. All of that would be valued and given out to investors under that equity yield sleeve. As well, heaven forbid, if we do have a loan that goes into default, we will call our security, take possession of the company, and the value of that company above and beyond the value of the loan would be captured in that equity yield sleeve. And then we do always have a portion in cash, and that can vary. Again, anything though between 3 and 5%, we would consider the fund fully deployed. So as you can see, we were fully deployed at the end of 2024 as of December 31st or the beginning of 2025 with cash sitting at 4%. So let's dive a little bit deeper into the lending side of the portfolio. I'm going to talk first about our direct lending. So we operate like a private bank. We're looking at loans anywhere in size from 5 million up to 50 million. So we'll never go higher than 10% of the fund's total size. So when our fund is sitting just over 500 million in AUM, kind of maxes us out at that 50 million. However, as you can see, the average loan size in the portfolio was only 7.6 million. So well under that cap of 50 million. Our terms that we're looking for are anywhere from 6 months up to 3 years. So our bread and butter, or where we tend to play, is in short-term corporate bridge loans. And as you can see, the average in the portfolio right now is 2.5 years. So every 2.5 years, this portfolio is constantly turning over. And then the interest rates that we're looking at on the direct lending is typically 12% plus, and the average interest rate on December 31st in the portfolio was about 13%. At that time, we had 28 lending arrangements within the portfolio. Out of those 28, 27 of them were in first secured position. And we typically have to be in first secured position when we're entering into any of our loans. The only time we will look at a second position is in our multifamily residential mortgages. We will look at a very conservative second position. One of the other things I do like to talk about on the lending side of things, I like to clarify that we focus on 100% cash pay loans. So we don't do any PIK or payment in kind loans. These loans have to make monthly interest payments to us as we're making monthly distributions to our unit holders. If you look here, this is a breakdown of the lending side of the portfolio when it comes to sector allocation and geographic allocation. So as you can see, we're transacting on both sides of the border. We can go across North America when it comes to the lending side of the portfolio. And we are extremely diverse when it comes to our sector allocation. As you can see here, one thing I do say though is don't fall in love with any one sector, as this does change on a quarterly basis. We do have a lot of turnover on the lending side of the portfolio. The other thing I like to point out is we do tend to have a 5% or less exposure to real estate, just because we like to be a great diversifier to a lot of our investors or clients' real estate holdings. You know, we're a great diversifier to all of those other alternative positions that you have in real estate. So let's talk about the other side of the lending portfolio. So if we look at, as of December 31st, 45% of the lending sleeve was in our direct lending, and 55% of the lending sleeve was in our syndicated credit. So we love the syndicated credit market. Unfortunately, Canada is too small to have a syndicated credit market. This is only down in the US. But what we like about that is it allows us to participate in these really large private loans down in the US alongside top tier private lenders in the US. So we're typically participating in about a $500 million loan, and we're just taking a teeny tiny chunk, maybe 1 to 1.5%. On average, I believe our loan size again is less than $10 million. On that side, and we had 13 different positions on the syndicated credit sleeve. And the other thing that we like about this is the liquidity that you can find in the syndicated credit market. So we get daily valuations. These are traded on the daily market. So we can have liquidity within this sleeve in anywhere from 7 to 30 days. So again, within 30 days, we could liquidate this entire sleeve if we needed to. And because we're picking up teeny tiny chunks of these large syndicated loans, we don't, come off as a competitor to these large private lenders, and so they love having us along. So we are invited in on the beginning of a lot of these syndicates, and then again we're able to jump into some positions on the secondary market as well. And when we do that, we're usually able to get in at a discount. So again, it's been a great sleeve within the portfolio, and it's offering similar results as our direct lending. These have to be 100% secured first lien positions, and our average yield to maturity was sitting around 13% as of December 31st. So when you are looking at private debt or private credit in general, there's some key metrics that you want to pay attention to or look at. So one of the things that is very important on the private debt side of things is pipeline. So you never want to have your fund manager in a situation where they don't have a robust pipeline and they're really scrambling to get money to work because they don't want to have cash straight. So as of December 31st, we had over 230 million in deals in our current pipeline at various stages of due diligence. As of the December 31st, we had 99% of our loans in the portfolio were performing. We had, I believe, 0.03% in arrears. So if you miss one monthly interest payment, you are immediately considered in arrears. And we had 0.07% in default. You always want to look at the trailing 12-month cash or distribution coverage ratio. And as of December 31st, it was 1.91. So how I like to break that down is for every dollar that the fund had to pay out in distributions, the fund was bringing in 1.91. So again, very healthy on the cash flow side of things that the fund was generating. And part of that is we only had a 4% cash allocation, so really minimizes our cash drag in the fund. And in those last 12 months, so that would have been 2024, we completed 158 million in deals. And in that same time period, we had 112 million in repayments. So again, that's what you want to see when you're looking at a private debt or private credit fund. You want to see that constant turnover, that constant repayment coming in. You never want to be on the bridge to Neverland. Now, let's get into a bit of an energy update or go into the energy side of the portfolio, as the way that we play energy is quite unique. So instead of being a traditional operator where you have, high control, high costs, more barriers to entry, the way that we play energy is through non-operated energy working interests or royalty positions. So essentially, the fund owns land and mineral rights. And the reason that we play energy this way is on the non-operated side. Yes, we give up control because we're not the operator, but it is extremely low overhead and extremely low cost of entry. So we like to do what we say, get our investors as close to the wellhead as possible and get them wellhead economics. So the way that we play energy, and because our overhead is so low, I believe it's typically hovers around $13 US per BOE or barrel of oil equivalent. Even if we see energy prices, dip to maybe even $40, which right now, I think it's hovering in the 60s, we still make good money. So that's why we're playing energy the way that we do. We also have a couple royalty positions within the fund. However, royalty positions are a little harder to get into. There's more competition on that side. So we do bid on royalty assets all the time. They're just, like I said, a little harder to get in at the price range that we're willing to pay. However, we do love royalty positions because it's exactly like it sounds. It's just a one-time upfront cost to purchase the package. And then like royalty, you sit on your throne and just collect checks from there on. So again, these are the two ways that we play energy, either through our royalty or non-operated energy working interests. So we talked about this, some of the benefits and features. We have lower concentration risk, less competition to get into, lower overhead and administration costs. And we're really able to diversify the portfolio by playing energy this way as well. So as you can see here on this slide, we are participating in over 2,000 producing wells across Canada and the US. In Canada, we tend to be more gas weighted, and it's the opposite for the US. We tend to be more oil weighted within our positions there. And the two royalty positions that we have in the fund right now are both down in the US. I always like to talk about this and bring up one of our most recent transactions. It would have been, a couple years back in December of 2020. The Eagle Ford Basin in Texas there, that was a royalty position that we picked up. ConocoPhillips is the operator there. When we bid on that asset, it was about producing about $270,000 a month in revenue coming in. And since we purchased that in December of 2020, as of October 2023, so not even a full year of holding that asset, it was producing $970,000 a month, or bringing in $970,000 a month in revenue. So again, love those royalty positions. They're just a little tougher to get into. On the non-operated side, it's a little bit different. Like I said, we're owning land and mineral rights. So when a large operator comes to drill on our lands, we still have to pay our portion of the cost and we receive our portion of the revenue. So again, a little bit different in the way that it is, but a very unique way to play energy, and allows us to transact in the energy space without that typical volatility that you see when you're investing in a straight operated energy company. So I kind of talked about the fund and how unique it is pairing private debt, whether it's through our direct lending and syndicated credit, with energy working interest and royalty positions. So let's kind of talk about the details now, or get into what I call the terms of the fund. So we talked about this. Our total AUM is just over 500 million. We are available for all of your registered accounts. The minimum investment amount is $5,000. However, we do waive the minimum on any follow-on capital. So let's say you decided to make a purchase, and at the end of the year in December, maybe you had an extra $2,000 kicking around in your RSP and you didn't know what to do with it. If you're adding to your current Invico position, we will waive the minimum. All of your purchases are done at our quarterly NAV, or unit price. Our closes are once a month on the last Wednesday of every single month. We offer quarterly redemptions with notice period. So we do need to see that redemption request 45 days prior to quarter end, and we settle it or pay out 45 days after quarter end. We do not have any lockups or redemption caps. However, we do have a redemption schedule that I'll go through with you on the next slide. There is a flat $200 redemption fee on all redemptions. That is our admin cost on this. So that's outside of the redemption schedule that we'll review. We do pay monthly distributions. They're paid out on the last business day of every single month, 1 month in arrears. You can either take that as cash, or you can have it reinvest on our DRIP program. As well, you can change that at any time. So we do have some investors that like to take cash distributions for half the year, and then they switch it over to DRIP and have it reinvest for the second half. Again, totally up to you and what you're looking for. So we're targeting that base 8% a year paid out monthly, which works out to, for 2025, as 0.0665 cents or dollars per unit per month. We do have a blended hurdle of 8%. So that hurdle rate is set at the beginning of the year. It is prime plus 425 basis points. It has a floor and ceiling. So it has a ceiling of 8, so it'll never go above that, and a floor of 5, so it'll never go below that. And what the hurdle rate does is it really protects investors. So what it means is the first 8% goes directly to investors. Then, because it's a blended hurdle, there's a small catch up on fees there. And then anything above that gets split out, 80% to you investors, 20% to Invico. The difference is investors get to collect on their 80% on a quarterly basis, whereas Invico can only accrue their 20%. We cannot collect until the auditors come in at the end of the year, confirm we hit that base hurdle of 8% for all unit holders before we can collect on our portion. So I like this because it really aligns our managers with our investors. We have to hit that first 8% for investors before we're allowed to participate alongside with our 20% portion. However, we have that nice set of checks and balances in place by having the auditors come in at the end of the year to confirm before we collect our portion. So again, great feature of the fund there. As well, Just note that this does pay an upfront 5% commission to the dealer and a 1% trail after that. So that's why we have that redemption schedule that I'm going to review on the next slide. And then we have a flat management fee of 1.75%. And as I mentioned, we don't have any lockups or caps on redemptions. However, because we're paying that 5% commission on your behalf upfront to the dealer, if you redeem within those first 5 years, we will claw back that commission, and it goes down by 1% for every year that you hold the fund. So even though we don't have any lockups or caps on redemptions, I would still go into this with, a 5-year plus time horizon, just so you can work through this redemption schedule. And then another thing that I do like to point out, we do have a proprietary Invico portal that you have access to after you make your investment. That portal will auto-generate quarterly statements for you and send you a nice little notification letting you know it's available. You can also go on and generate a statement at any time you like. As well, it's going to send you a nice little notice when you get your monthly distribution every month. All of our tax slips are housed in the portal under the document center. So it's a really nice feature just to have that there at your disposal. As well, once you've held the fund for a year, it starts to calculate your performance numbers on there. So great feature to have. As well, I want to talk about, more of the checks and balances that we have in place at Invico Capital Corporation. We have been audited since inception as a firm and a fund. As well, for the last 7 years, I believe it is now, we have worked with an IRC, or Independent Review Committee, that reviews all of the deals that we have within the fund and anything that can be seen as at arm's length. So again, a nice set of checks and balances for investors' peace of mind. So that's really it. Please reach out to your DR if you have any questions on the fund, and we'd be happy to help and go a little deeper into detail if you'd like.